You ever walk in somewhere or see someone and you just have that feeling of deja vu? Like, golly, this is familiar. That's exactly what's going on for many investors, is the feeling of deja vu, or the feeling of we've been here before. Because we have.
Yes.
And so what this reminds us of is 2016. And so I'm going to throw up a chart here, and you'll see on the chart that in 2016, the first 20 days of the year were the worst opening 20 days in recorded market history.
Worst. That's really bad.
And then the market finishes up 12.5% for the year. So 20+% from the bottom there, but up 12.5% for the year. Well, let's fast forward to 2018. I'm going to put up another chart here, and I want you to notice this, that the last 90 days of the year, right after our second Supreme Court justice, right after the midterm elections where the Democrats took the House, the market fell 20% roughly in the last 90 days of the year, but we all remember how good 2019 was because of what we were able to buy at those discounted prices. So we say all of that to say we've been here before.
Yes.
Well, let me ask you a question then. Why didn't we look into the crystal ball and simply sell at the high last November and get out of everything?
Right. Thanksgiving would have been the high, and had you known the next 6 weeks, next 2 months, but think about what was going on in Thanksgiving. Is we were just looking back on fantastic earnings. We were looking forward on growth of earnings. Our economists were starting to talk about the potential for Dow 40,000. What I think we forget, now if we thought recession was coming, we would have started getting out. If we knew you need, and we always ask, what kind of spending do you have going forward? Do you have any big purchases? Because we want to know that, because at intervals when we want to take profits, we want to buy low, sell high. So, but we expect the market to continue to grow. What's interesting about this pullback, here we are down, the NASDAQ roughly 20% from the high, the S&P roughly 10%, some sectors 40% pullbacks. Just think how all that volatility sounds. You wouldn't think these are normal ranges of returns, positive and negative, in the stock market. With the S&P standard deviation or up and down 14%, the NASDAQ almost 20%.
So what you're saying there is it is completely normal and totally within the expectation for investors for the stock market to drop 15% and it'd be no big deal.
Yes, but after a year like last year, remember, not a lot of volatility.
Yep.
Market up 5, down 7, up 7, down 5. We didn't have any extreme swings. And so as investors and as humans, we normalized last year. And so this feels abnormal. And some people think, I got to get out.
Yeah.
And I think that's what's fueling matter of fact, we know. That's what's fueling some of this pullback is retail investors thinking the bull market's over.
Yeah, so then normalize this moment for us by saying, what is this not?
Yeah,
what is not going on?
Well, it's not the beginning of a recession. Matter of fact, we aren't perma bulls.
That's right.
We've gone through recessions before.
Yep.
And last time we did, we started getting out as the market was breaking through valuations leading to... So we would have been getting out last November
Had
we believed a recession was coming.
That's right.
This is nothing we see today tells us we're heading into recession yet.
There's also a storyline that probably many of our clients across the country have seen about a fundamental shift in the market. Growth has been good for so long, value is now in play, and that you need to be having a systematic change in your portfolio if you want to have any hope of surviving this moment.
I've read some of those and watched that a little on TV. And now, of course, there's always a little truth in some of those statements.
Yeah.
And a lot of these prognosticators like to give little truths, and then when that little truth is correct, they come 30 days later and pound on how right they were.
That's right.
Now, we have value investments in our portfolio, but we do not see an exodus on growth to value. Because if that was true, then you would also see the 10-year Treasury going up at a very high rate, because that means interest rates are going to go higher quicker.
Yeah.
Inflation's here to stay, we don't believe, and the 10-year Treasury has now backed off down to 1.7%. If it was climbing to 2.5, 3, 3.5, 4,
Yeah.
then dividend paying, strong balance sheet, mom and pop returns would be more palatable in the short term. So there is a little of that going on, but we don't agree with it. We don't think you should throw your growth stocks out. We still believe innovation, biotech,
Yep.
robotics, automation, cars driving you around, your kitchens today. I mean, is
Yeah.
it more of a plumbing item, or are they more computers who do plumbing items?
That's right. Bluetooth refrigerators.
I mean,
and
it
such.
tells you when to go shopping.
Yes. Well, not my fridge, but
Well, mine,
Somebody's.
we remodeled.
yeah.
So.
Okay. So, I think what's important in this moment.
And even in that,
Okay. No, go ahead.
I don't mean to make light of what's going on. This hurts. I mean, it's hard to watch the November highs get eaten up.
Yeah.
It's hard to watch values go down. And so this is where we always talk about, we're going to be pragmatic. We're going to not let emotions dictate our investment philosophy. We're going to let fundamentals of profits, PE multiples, and the top sectors of innovation and growth drive our philosophy. So we don't want to discount the emotions.
Yeah.
None of us, not you, not me,
My account's down.
none of us like to see our accounts go down. But it's where are they going to be 12 months from now? If you think fundamentally 12 months from now, your account's going to be negative, then you should not be in growth investments. You have to believe the economy is doing better, and the Fed would not be raising interest rates into a weak economy.
That's right.
And maybe share a little bit, how well do stocks do after the first Fed increase?
Well, they typically do well to the tune of double-digit returns after there's even an incremental increase in interest rates.
Yeah.
And we can land the plane on this. I was doing a puzzle with my 2.5-year-old, and it's really her just bossing me around, telling me what puzzle pieces go where, and then I have to put them in. But think about what we're talking about as piecing together all of the financial puzzle that's on the table. And so what I mean by that is we are a lot like financial detectives, where we're looking at leading indicators. We're looking at interest rate. We're looking at the Fed's monetary policy. We're looking at profit. We're looking at all of these
Midterm elections.
Yes, all of these data points and saying, what does it mean and where do we invest? To protect first, but to grow second.
Yes.
And so we're going to be, and we've been asking the same thing we do every time there's downward pressure in the markets. We're asking critical, sober-minded questions and putting everything on the table. We don't try to pretend that we know everything.
That's right.
Part of, I think, general wisdom is knowing that you don't know
That's right.
everything.
The third rule.
And so I know you're flying out just in a matter of a day or two to meet with some of our money managers to ask these hard questions. What are we missing? Where do we need to be? Where's the most value with the least amount of risk?
Yeah, these are companies that we have 25-year relationships with, and that have been in the data. They understand the minutia of the market, and we're going to talk about opportunity, what we have that we may not like. But right now what we see is opportunity for this year. And remember, markets could go a little bit lower before they go much higher.
Certainly.
It's very important.
We've been here before. You've been here before, and we've been here before together. Thanks for watching. We'll see you next time.